Have you ever wondered why some people seem to borrow thousands of dollars without putting up their house, car, or anything else as collateral? How do lenders even agree to that? And is it as simple as it sounds? Or is there a catch you need to know about? Well, today you're about to find out. And what you learn could save you from making an expensive mistake. So stick with me, because what I'm about to reveal might just surprise you. Number 1. What exactly is an unsecured loan? Let's start simple. An unsecured loan is a loan that does not require you to put up any collateral. Collateral is just a fancy word for something valuable the lender can take if you don't pay them back, like your car or your house. So when you get an unsecured loan, you're basically saying, "Trust me, I'll pay you back." And the lender decides if they believe you based on your creditworthiness. Here's an example. Emma wants to borrow $5,000 to consolidate her credit card debt. Instead of risking her car as security for the loan, she applies for an unsecured personal loan. The lender checks her credit score, her income, and her history of paying bills, then decides to give her the loan without asking for any collateral. If she doesn't pay, the lender can't just take her car, but they can hurt her credit score and possibly sue her. Number 2. How is it different from a secured loan? This is where most beginners get confused. A secured loan does require collateral. Think of a mortgage. You borrow money to buy a house, and the house itself is collateral. If you stop paying, the bank can foreclose and take the house back. Or imagine a car loan. You stop making payments, and the lender can repossess the car. But with an unsecured loan, the lender has no property to grab. That's why unsecured loans usually come with higher interest rates, because it's riskier for them. Here's another quick example. Mike borrows $20,000 to buy a car. That's a secured loan, because if he doesn't pay, the lender just takes the car. But if Mike borrows $2,000 for a vacation using an unsecured personal loan, there's nothing for the lender to take back. Number 3. Why do lenders offer unsecured loans at all? It sounds risky, doesn't it? So why would they even bother? Because lenders make up for the risk in 2 ways. First, they charge higher interest rates, since there's no collateral to protect them. They have to make sure they're compensated for the chance you might not pay them back. Second, they rely heavily on your credit report. If you have a strong history of paying your bills on time, a steady income, and a good credit score, they're more likely to trust you. Think of it this way. You're basically borrowing against your reputation. If you've been responsible in the past, lenders will believe you're likely to keep being responsible in the future. Number 4. What are some common types of unsecured loans? You may not realize it, but you've probably already used an unsecured loan before. Credit cards are the most common example. You swipe your card, you're borrowing money without collateral. Personal loans are another. You can borrow a set amount, say $10,000, and pay it back in monthly installments over a few years. Student loans can also be unsecured, though some are backed by the federal government in the USA. Even some lines of credit at your bank are unsecured. Here's an example. Sarah needed to pay for her wedding but didn't want to max out her credit cards. So she took out a personal loan with fixed monthly payments and a lower interest rate than her cards. That's an unsecured loan. Number 5. Who qualifies for an unsecured loan? This is where many people get nervous, and rightly so. Not everyone qualifies, because lenders can't grab your car or house if you stop paying. They need to feel confident that you're trustworthy. That means they'll usually want to see a good or excellent credit score, often above 670, proof of steady income, a low debt-to-income ratio. Here's an example. Tom has a credit score of 720, a steady job making $45,000 a year, and very little debt. He's approved quickly for a $7,000 personal loan. But his cousin, Dave, has a credit score of 590, lots of unpaid bills, and irregular income. His application is denied, or he's offered a loan at an extremely high interest rate. Number 6. What are the pros of unsecured loans? Unsecured loans can actually be a smart move in the right situation. Here are some big advantages. You don't risk losing your house, car, or other property. The process is usually quicker. No need to appraise collateral. You can use the money for just about anything. For example, if you're trying to pay off high-interest credit card debt, an unsecured personal loan with a lower rate can save you hundreds or even thousands of dollars in interest. Or if you need money for an emergency, you can often get approved and funded within a few days. Number 7. What are the cons of unsecured loans? Of course, there are downsides too, and you need to know these. Interest rates are usually higher than secured loans. Loan amounts are often smaller. You need strong credit to qualify. Here's an example. Anna wanted to borrow $40,000 to remodel her kitchen. Because she didn't want to risk her home as collateral, she applied for an unsecured loan. But the lender only approved her for $15,000, much less than she needed, and at a higher rate than a home equity loan would have charged. So unsecured loans can be more expensive, especially if your credit isn't great. Number 8. What happens if you don't pay? This is the part no one likes to think about, but it's important. If you stop paying on an unsecured loan, the lender can't just show up and take your stuff. But that doesn't mean you're off the hook. They can send your account to collections, report the missed payments to the credit bureaus, and even sue you in court to recover the money. If the court rules against you, they might even garnish your wages, meaning part of your paycheck goes straight to them before you even see it. For example, Kevin stopped paying his unsecured loan after he lost his job. His credit score dropped over 100 points, and the lender eventually took him to court and won a judgment against him. Number 9. How can you get the best deal? Now for the part you've been waiting for. How do you actually get a good unsecured loan without getting ripped off? Here are a few quick tips. Check your credit report and fix any errors before applying. Shop around and compare offers from different lenders. Look for the lowest interest rate and the shortest term you can afford. Don't borrow more than you really need. For example, Lisa needed $8,000 to pay medical bills. She got quotes from 3 lenders, and the rates ranged from 12% to 18%. By shopping around, she saved hundreds of dollars in interest over the life of the loan. Number 10. Is an unsecured loan right for you? This is the big question, and the answer depends on your situation. If you have good credit, stable income, and need a smaller amount of money without risking your assets, an unsecured loan can be a great choice. But if your credit is shaky or you need a very large amount, you may want to consider other options, like a secured loan or working to improve your credit first. For example, Josh wanted to borrow $30,000 to start a small business. His credit was poor, and unsecured loans were offering him sky-high rates. Instead, he decided to wait 6 months, work on his credit, and save up more before applying again. Number 11. How much can you actually borrow? One common question beginners have is how much money they can get with an unsecured loan. The answer is, it depends on your credit score, your income, and the lender's policies. Most unsecured personal loans in the USA range anywhere from $1,000 to around $50,000. For example, Ben with excellent credit and a high salary was approved for $40,000. But his neighbor Claire, with average credit and lower income, could only get approved for $8,000. Keep in mind, even if you're offered more, you don't have to take the full amount. Only borrow what you really need. Number 12. How long do you have to pay it back? Another thing people wonder is how long the loan lasts. This is called the term of the loan, and it's usually anywhere from 1 year to 7 years. Shorter terms mean higher monthly payments, but you'll pay less interest overall. Longer terms mean lower monthly payments, but you could end up paying more in interest. For example, Maria borrowed $10,000. On a 3-year term, her payments were around $300 a month. On a 6-year term, her payments dropped to about $180 a month, but she paid almost $2,000 more in interest. Number 13. Can you pay it off early? A lot of people ask if they can pay off an unsecured loan early without a penalty. The good news is, many lenders allow early repayment with no extra fees, but some lenders do charge what's called a prepayment penalty. Always check your loan agreement before signing so you know whether you can pay it off faster if you want to. For example, Sam paid off his loan 2 years early and saved hundreds in interest because his lender didn't charge any penalties. Number 14. What about online lenders? In recent years, online lenders have made unsecured loans easier to get than ever before. You can apply online, upload your documents, and sometimes get approved the same day. But be careful. Not all online lenders are trustworthy. Look for lenders that are licensed, have good reviews, and clear terms and conditions. For example, Jessica applied with a reputable online lender and got her funds within 48 hours, but her cousin fell for a scam site, paid processing fees up front, and never got the loan. Number 15. What are some alternatives to unsecured loans? Finally, it's good to know you have other options if an unsecured loan doesn't fit your needs. You could consider a secured loan if you're comfortable. Using collateral, you might look into a home equity loan or line of credit if you own a home. Some people even borrow from family or friends, though that can be risky to your relationships. For example, Dylan needed money for car repairs but didn't qualify for an unsecured loan. Instead, he got a small secured loan using his motorcycle as collateral and paid it off in 6 months. So now that you know the ins and outs of unsecured loans, the good, the bad, and the surprising, what do you think? Would you rather take a higher interest rate to protect your property or use collateral to get a better deal? Let me know in the comments below. I'd love to hear what you choose and why.